In the last video, we looked at why Britain is trying to rebuild parts of its financial system at precisely the moment the country is facing rising debt, weak productivity, and increasingly difficult long-term choices. But understanding why the government wants change is only half the story. Because the next question is, what exactly is it trying to change? The answer is not simply banking apps, digital pounds, or allowing people to pay with stablecoins. The UK is targeting something much deeper: the hidden wholesale markets that sit underneath the entire financial system. These are the markets where governments borrow, banks manage liquidity, pension funds move collateral, companies raise finance, and enormous transactions are settled every day. Most of us never interact with these markets directly, but they affect the interest on your mortgage, the value of your pension, the cost of government borrowing, and ultimately the amount of money available for public services. And the UK has now decided that the technology running those markets needs to be modernised. On the 13th of July, the UK's wholesale digital markets champion Chris Woolard delivered a new report to the Chancellor setting out how Britain could accelerate the tokenisation of wholesale financial markets. This was not a report about launching another speculative crypto token. It was about tokenising existing financial assets: government bonds, corporate bonds, investment funds, shares, and the collateral banks use when borrowing from one another. The report says the UK already processes more than £4 trillion of securities transactions on an average day. That gives you an idea of the scale we're discussing. However, despite the enormous size of the traditional financial system, tokenised assets still represent only around 0.01% of investable assets globally in 2025. The important part is what happened next. According to the report, the value of tokenised assets grew by approximately 300% during that year, and forecasts cited in the document suggest that the market could reach $88 trillion by 2035. But Britain doesn't need the full $88 trillion market to materialise for this to matter. If even a fraction of global stocks, bonds, funds, and collateral begins moving onto digital infrastructure, the countries hosting that infrastructure could gain business, jobs, tax revenue, and influence over the standards governing it. And that is why the UK appears to be treating this as a competition. The City of London has been one of the world's most important financial centres for generations. But being a leader in the old financial system does not automatically guarantee leadership in the new one. If tokenised assets are issued in one jurisdiction, settled through infrastructure based somewhere else, and traded using standards developed by another country, the UK risks losing part of the financial industry it currently hosts. So this is not merely a technology experiment. It's an attempt to protect the City of London's position as financial markets are rebuilt. The first major area the report focuses on is government debt. When the UK government needs to borrow money, it issues bonds known as gilts. Investors lend money to the government by purchasing those gilts, and the government agrees to pay interest and eventually return the original money. These gilts are not an obscure corner of finance. They're the foundation of the British financial system. Banks hold them, pension funds hold them, insurance companies hold them, overseas investors hold them. They're also used as collateral throughout financial markets because UK government debt is generally treated as a highly credible asset. The government is now developing a digital gilt instrument known as Digit. HSBC was appointed as the platform provider for the pilot in February 2026. The digital gilt is intended to sit separately from the government's normal debt issuance programme. So this is initially a controlled pilot rather than Britain moving the entire national debt onto a blockchain overnight, but the significance is larger than the size of the first issuance. A digital gilt allows the government to test whether sovereign debt can be issued, owned, and transferred through distributed ledger infrastructure. Once a government bond exists in a digitally native form, other services can begin developing around it. It could potentially be used as digital collateral. It could be exchanged against tokenised money. Ownership records could update much faster. Interest payments could eventually be distributed more efficiently. Transactions could potentially settle without several separate organisations maintaining and reconciling different versions of the same information. That word, reconciliation, is one of the most important parts of this story. In traditional finance, different institutions often maintain their own records of a transaction. The buyer has a record, the seller has a record, the banks have a record, the custodian has a record. The clearing and settlement infrastructure may have additional records. Those systems need to agree. When they don't agree, institutions must investigate the discrepancy. That costs time and money and introduces operational risk. A shared ledger doesn't magically eliminate every risk, but it could allow multiple authorised participants to work from a common record that updates almost simultaneously. The Bank of England has said this could make payments and settlements faster and cheaper, reduce the number of intermediaries, lower operational risk, and shorten settlement windows. And this becomes particularly important when we talk about collateral. Collateral is an asset offered as security when one institution borrows from another. If the borrower fails to repay, the lender has a claim over that asset. Government bonds are frequently used for this purpose. One of the largest places this happens is the repo market. Repo is short for repurchase agreement. Imagine a bank needs cash overnight. It transfers government bonds to another institution in exchange for cash and agrees to buy those bonds back shortly afterwards at a slightly higher price. Economically, it functions like a secured loan. The bonds are the collateral, and the difference between the original price and the repurchase price reflects the cost of borrowing. Repo markets are vital because they allow banks and financial institutions to access short-term cash while giving lenders protection through high-quality collateral. They also help transmit Bank of England interest rate decisions through the financial system. But collateral is not always available exactly where and when an institution needs it. An asset may be sitting with one custodian, recorded in one system, or restricted by the operating hours of a particular market. Moving it can require instructions to pass through several organisations. That creates something known as collateral friction. A bank may technically own enough valuable assets to support a transaction, but still be unable to move the correct asset to the correct place quickly enough. The institution may therefore keep additional cash or securities available as a buffer. That is safer, but it also means capital sits idle rather than being used elsewhere. Tokenised collateral could change this. If ownership of a gilt, bond, or other eligible asset can be updated through shared infrastructure, the collateral may become easier to identify, transfer, and reuse across approved financial systems. This doesn't mean that the same asset can irresponsibly be pledged multiple times. The rules governing collateral would still matter enormously. The objective is greater visibility and mobility, knowing where an asset is, whether it's already committed, and whether it can be transferred. This could reduce the amount of liquidity institutions need to hold purely because today's systems are slow or disconnected. And when banks use their balance sheets more efficiently, the effect can spread beyond the financial markets. It could affect the cost and availability of credit for businesses. It could reduce operational costs. It could allow financial institutions to complete transactions using less trapped capital. That doesn't guarantee cheaper mortgages or business loans. Banks could retain some or all of the savings. But this is the theory behind the government's claim that wholesale tokenisation can support wider economic growth. The new report, therefore, doesn't focus solely on issuing tokenised assets. It places considerable emphasis on creating secondary markets. That distinction matters. Issuing a tokenised bond is relatively easy compared with creating a market where many investors can buy it, sell it, borrow against it, settle it, and connect it to existing infrastructure. A digital asset with no active secondary market can become little more than an impressive demonstration. For tokenisation to operate at scale, investors need liquidity. They need reliable prices. They need legal certainty. They need custody arrangements. They need settlement assets. They need accounting and tax rules. They need systems that can communicate with one another. And this is why interoperability appears repeatedly throughout the UK strategy. Britain doesn't want dozens of separate digital platforms that can't connect. That would simply recreate today's fragmented financial system using newer technology. The difficult question is how a tokenised asset issued on one platform can move to another platform, interact with traditional systems, and be settled using dependable money. That settlement side of the transaction is crucial. It's not enough to move the asset, the payment must also move. The Bank of England continues to argue that central bank money should play the critical role in financial settlement for wholesale markets. That means the safest form of sterling, the money ultimately backed by the central bank, remains at the centre of the system. However, the bank has also acknowledged that stablecoins could play a complementary role alongside commercial bank money in wholesale settlement. That is a significant development. That means Britain is no longer discussing stablecoins as something consumers might use to buy goods or send money internationally. The authorities are also exploring whether appropriately regulated stablecoins could help settle tokenised financial market transactions. This is the work being tested through the Digital Securities Sandbox. The sandbox allows firms to operate real financial market infrastructure using new technologies, but within the limits overseen by the Bank of England and the Financial Conduct Authority. This is important because the UK is attempting to move beyond demonstrations and into controlled live activity. The objective is to test tokenised securities, settlement, and market infrastructure under real-world conditions before allowing the system to expand. And that tells us what Britain is actually building. This is not one government blockchain. This is not one token that replaces everything. It's an ecosystem in which traditional assets and digital native assets may exist alongside each other. Central bank money, commercial bank money, and regulated stablecoins may perform different settlement functions, and multiple platforms may connect through agreed legal and technical standards. That's why the work involves HM Treasury, the Bank of England, the FCA, and private companies. The government can create the legal framework and issue digital gilts. The Bank of England can protect monetary and financial stability and determine how trusted settlement money should work. The FCA can regulate market participants and protect market integrity, but private companies will build much of the infrastructure. The UK report says 54 businesses have been brought together to help deliver the programme. These include different parts of the financial ecosystem rather than one blockchain company being handed control. The competition will therefore be over which platforms, networks, custodians, and settlement systems become part of the eventual structure. This is where the connection to crypto becomes more complicated than simply asking which coin wins. Public blockchains have demonstrated that assets can be issued and transferred digitally across shared networks. Stablecoins have demonstrated that dollar-denominated value can move around the world continuously. Decentralized finance has experimented with automated trading, lending, and collateral. Traditional finance is now taking some of those ideas, but surrounding them with regulated institutions, identity requirements, legal ownership rights, risk controls, and access restrictions. The result may not look like the open crypto markets people use today. The ledger may be permissioned. Transactions may only be visible to approved participants. Assets may only be held by regulated entities. Certain functions may be reversible under legal authority. But the underlying direction is familiar. Assets becoming programmable, records becoming shared, and settlement moving closer to real time. This is also why large financial institutions are spending so much money developing tokenisation projects. They're not doing it because they suddenly agree with every principle associated with Bitcoin or decentralised finance. They're doing it because the existing financial system contains costly delays, duplicated records, fragmented liquidity, and capital that can't always move efficiently. Tokenisation offers a potential way to improve that machinery. The strongest argument for the UK strategy is that it could make markets more efficient, keep financial businesses in Britain, and allow the country to shape global standards. The strongest argument against it is that technology does not automatically create liquidity or trust. A poorly designed tokenisation system could create new cyber risks, new concentrations of power, and new forms of financial instability. Faster settlement can reduce risk in one area while creating demand for immediate liquidity somewhere else. Interoperability can also become a slogan rather than a reality if commercial platforms have little incentive to connect with their competitors. And none of this solves the deeper reason the UK is borrowing so heavily. Tokenising a gilt does not reduce the government's debt. A digital bond still has to be repaid. It doesn't solve weak productivity, an ageing population, or the long-term cost of pensions, healthcare, and public services. What it could do is make the financial infrastructure surrounding that debt more efficient and make the UK more attractive as a place to issue, trade, and service global assets. So, Britain is not using blockchain to escape its economic problems. It's trying to ensure that while dealing with those problems, it does not lose its position at the centre of global finance. And that leads us to the final part of this series of videos. Because the wholesale market might sound distant from ordinary life, but they are connected to the price of mortgages, the performance of pensions, the taxes governments collect, and the money people may eventually use. In the next video, we're going to look at what Britain's financial rebuild could mean for households, savers, and investors, and whether ordinary people will genuinely benefit from it. So now we know what Britain is actually building. It's not just a digital pound, it's not just blockchain, and it's not just crypto. It's a new financial infrastructure that could eventually sit underneath everything from government bonds to digital payments. And this is exactly why I believe it is so important not to just follow the headlines, but to understand how all of these pieces fit together. Because once you understand the bigger picture, you're in a much better position to make informed decisions instead of simply reacting to the news. And that's exactly what we do inside the Crypto Wolfpack. Every day we break down macro events, regulation, market structure, and crypto developments that really matter, helping our members connect the dots and understand exactly what's happening beneath the surface. And if that sounds like something you'd enjoy, you'll find the link to the Crypto Wolfpack in the description below. If you've enjoyed this video, I'd really appreciate it if you could give it a like, as it really helps the channel reach more people. Let me know your thoughts in the comments as well. Do you think Britain's push towards tokenisation will genuinely strengthen the UK's economy? Or is this simply the next evolution of financial technology? And if you haven't already, don't forget to subscribe so you don't miss the next part in this series, where we'll look at what all of this could mean for your money, your investments, and the future of crypto. Thank you so much for watching, and I'll see you in the next one.